There's a certain melody that plays when interest rates dip low. It's a siren song, promising ease, suggesting a landscape of abundant opportunity. Central banks lower rates, aiming to stimulate economies, to make borrowing cheaper, to encourage spending and investment. On the surface, it seems like a benign, even beneficial, economic condition. But for the data-driven investor, for the one who looks beyond the immediate melody, this seemingly benign environment can mask significant, emergent risks. It's a landscape that demands not just attention, but a deeper, more critical understanding. Benjamin Graham, the father of value investing, once wisely stated, the investor's chief problem is never the market itself, but rather his own emotions and behavior. In this low interest rate environment, that timeless wisdom takes on a more urgent hue. Complacency can creep in, a quiet assurance that the easy path is the only path, a relentless search for yield, a natural inclination when traditional safe havens offer so little, can amplify these emotional pitfalls. It can lead to a dangerous overreach, a willingness to take on more risk than is truly warranted, all in pursuit of returns that seem just out of reach in a low-rate world. This isn't just about the predictable decline in bond yields, the most obvious casualty of low rates. We need to move beyond the apparent. We will delve into the less apparent dangers, the subtle, systemic vulnerabilities that this persistent condition creates. We will dissect the risks lurking in equity valuations, the shifting sands of credit markets, and the behavioral traps that are amplified by this economic law. This is a journey to uncover the hidden reefs beneath the deceptive calm of low interest rates, a necessary exploration for any investor serious about protecting and growing their wealth. In a low interest rate regime, the traditional havens of safety, like government bonds and even high-grade corporate debt, offer yields that are simply insufficient for many investors' long-term needs. Whether it's funding retirement or generating reliable income, the meager returns from these assets become a stark reality. This scarcity compels a desperate search for yield, a powerful force that pushes capital, often with a sense of urgency, into riskier credit instruments. Picture a desert oasis, its life-giving water soars slowly but surely drying up. Travelers, parched and desperate, begin to dig shallow, unstable wells closer to the treacherous edge of the desert. They risk collapse for a few more drops. In a similar fashion, investors too often abandon the historically reliable, albeit low-yield, well of safe bonds. They turn instead to riskier, less transparent debt instruments, think junk bonds or the burgeoning world of private credit. These promise more, yes, but they carry a significantly higher risk of default, especially when the economic conditions inevitably shift. The myth that often takes hold is that simply diversifying into high-yield bonds equates to maintaining safety. The hidden danger, the truth the data reveals, is that during economic downturns, the correlations between these high-yield instruments and equities tend to spike dramatically. This means these supposed safer yield enhancers can begin to behave much like volatile stocks, precisely when you least expect it, amplifying your losses when you're most vulnerable. Therefore, the actionable insight here is to implement a rigorous credit quality analysis framework. Don't just glance at the headline yield. You must scrutinize balance sheets, debt-to-equity ratios, interest coverage ratios, and the issuer's resilience within their industry. Consider laddering maturities to mitigate interest rate risk should rates eventually rise. And crucially, ensure any exposure to low-rated debt is truly a tactical, small allocation, not a foundational pillar of your portfolio. The pursuit of yield in a low-rate world is a tightrope walk over a deep canyon. The data consistently reveals that the perceived safety of the higher yield often conceals a far greater risk of falling. Low interest rates have a profound, almost mathematical, effect on how we value assets. They drastically reduce the discount rate used in critical valuation models, such as discounted cash flow analysis. This mathematical shift has a direct consequence. It inflates the present value of all future earnings. Consequently, stock prices are pushed higher, often to levels that become significantly detached from the underlying business performance. It's a powerful, yet often unseen, force at play. Imagine the valuation of a house. Its worth is intrinsically tied to the rental income it can generate. Now, what happens if interest rates, the very cost of borrowing to acquire that house, plummet to historic lows? The theoretical value of that rental income increases significantly, even if the actual rent collected remains precisely the same. In a low-rate environment, this interest rate effect can inflate stock valuations across the board. It creates a subtle but dangerous disconnect between the soaring stock prices and the actual economic engine driving the company. The myth that often emerges is that a rapidly rising stock market is always an irrefutable sign of a healthy, innovative economy. But the hidden danger lies in the systematic overvaluation of growth stocks and companies whose profits are heavily weighted towards the distant future. These assets become exceptionally vulnerable. A minor increase in interest rates or even a single negative earnings surprise can trigger a significant and rapid correction. Therefore, the actionable insight insight for the data-driven investor is to focus on valuation metrics that are inherently less sensitive to these fluctuations in discount rates. Analyze price-to-earnings ratios, not in isolation, but relative to industry peers and their own historical averages. For asset-heavy companies, consider price-to-book ratios, and always look at free cash flow yield. Seek out companies with strong, sustainable earnings, robust balance sheets, and clear competitive advantages, the so-called moats that can help them weather periods of valuation compression. When interest rates are at historic lows, the stock market can sometimes resemble a mirage in the desert, shimmering with apparent value, but often built on the unstable foundation of cheap money, not intrinsic, enduring worth. Ultra-low borrowing costs, while seemingly beneficial, have a peculiar and insidious effect. They allow fundamentally unviable companies, often termed zombie companies, to refinance their existing debt. This keeps them artificially alive, even when they aren't generating enough profit to cover their basic interest expenses, let alone invest in future growth. This phenomenon doesn't just harm the companies themselves, it distorts entire industries and leads to a significant misallocation of precious capital. Consider a garden where the water is essentially free and plentiful. What happens? Gardeners might find themselves continuously watering and fertilizing weeds simply because the resources are readily available. These persistent weeds then choke out the healthy, productive plants that could otherwise flourish. In the broader economy, these zombie companies, kept alive by the cheap debt flowing through the system, consume vital resources. They tie up capital, demand talent, and occupy market share that more productive, innovative businesses could genuinely use. This ultimately hinders overall economic efficiency and stifles true innovation. The myth that often takes root is that a low-interest environment is universally good for all businesses, acting as a broad stimulus for growth. But the hidden danger is far more complex. This environment can artificially prop up weak, inefficient companies, disrupting the natural process of creative destruction. It leads to entire sectors becoming populated with underperforming players, making it significantly harder for investors to identify the true market leaders and the genuinely robust businesses. Therefore, when you are analyzing companies, pay extremely close attention to key financial metrics. Scrutinize interest coverage ratios, which measure a company's ability to pay interest on its outstanding debt, and debt-to-equity ratios. Look for trends that indicate increasing leverage or a consistent decline in profitability over time. Favor companies that demonstrate strong free cash flow generation, maintain low debt levels, and possess clear, demonstrable paths to sustainable profitability and a defensible competitive advantage. In the garden of commerce, free water can indeed lead to an infestation of weeds. Identifying and carefully avoiding these zombie companies is absolutely crucial for investors seeking to cultivate genuine, long-term, and sustainable growth. Sustained periods of very low interest rates, particularly when accompanied by quantitative easing, can have a significant and often underestimated consequence: currency devaluation. As central banks inject vast amounts of liquidity into the economy and the yield on domestic assets becomes unattractive, holding that particular currency can become less appealing for international investors seeking returns. Imagine a simple loaf of bread. Now picture a baker who starts printing an endless supply of bread tokens. If the actual number of loaves produced remains the same, but the number of tokens in circulation explodes, each individual token inevitably becomes worth less. Similarly, when a central bank floods an economy with money through the mechanisms of low rates and quantitative easing, the value of each unit of currency can decrease. This means, over time, your savings, your hard-earned cash, will simply buy less than it did before. The myth that often persists is that low interest rates primarily affect only bond yields and stock valuations. This is a dangerously incomplete picture. The hidden danger is the insidious, often unnoticed, erosion of purchasing power for cash holdings and fixed income investments. These assets may not keep pace with the subtle rise in inflation that can accompany such policies. It's akin to a hidden tax on savers, a gradual diminishment of wealth that goes unacknowledged by many. Therefore, the actionable insight is to diversify. Diversify not just across different types of assets, but also across different geographies. Consider assets that have historically demonstrated resilience against inflation or currency devaluation. This includes real assets like real estate and commodities, inflation-protected securities such as TIPS, or equities in companies that operate globally and possess significant pricing power, enabling them to pass on rising costs to consumers. It's also essential to be acutely mindful of currency exposure within your overall investment portfolio. A low-interest environment can sometimes feel like sailing on calm seas, but the subtle current of currency devaluation can slowly carry your purchasing power away. Unless you've wisely anchored your wealth in assets that can withstand the inevitable tide, prolonged periods of low interest rates, and consistently rising asset prices, prices can foster a dangerous complacency. This false sense of security amplifies behavioral biases like FOMO and recency bias, pushing investors to chase performance and neglect critical due diligence. Think of people accustomed to mild weather. They grow complacent about storms. When a sudden tempest hits, they are unprepared. Similarly, investors habituated to low rates and rising markets can ignore underlying risks, falling prey to FOMO and chasing speculative assets without proper analysis. The myth that the market knows best and that past performance guarantees future success in this low-rate era is pervasive. The hidden danger is that these amplified behavioral biases, fueled by easy money, drive rational investors to irrational decisions, buying high and selling low when volatility inevitably returns. To counter this, actively practice pre-mortem analysis before investing. Imagine the investment has failed. Why did it happen? Develop a disciplined process grounded in fundamental value, not market sentiment. Set clear entry and exit criteria. Regularly review your portfolio with a critical, unemotional lens, remembering the potential for mean reversion and history's lessons. The greatest risk in a low-interest environment isn't the market, but the erosion of our own critical thinking and discipline, turning us into passengers sailing towards unseen icebergs. We've journeyed through the deceptive landscape of low-interest environments, uncovering 5 hidden risks that can quietly undermine even well-intentioned investment strategies. We've seen how these seemingly benign conditions can inflate asset bubbles, encourage the accumulation of risky debt, and artificially prolong the existence of fundamentally weak companies. We've also explored the subtle erosion of currency value and the dangerous amplification of investor psychology through complacency and FOMO. The core message resonates through each of these points. The perceived safety of low interest rates is often nothing more than an illusion. True, sustainable financial security is not found in following the herd or in the naive assumption that current economic conditions will persist indefinitely. Instead, it arises from rigorous, data-driven analysis and a profound, nuanced understanding of the underlying economic currents that shape our markets. Warren Buffett, a titan of intelligent investing, once advised, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." In the context of low-rate environments, this wisdom becomes even more critical. Many merely fair companies can appear artificially wonderful due to the mechanics of valuation in a low-rate world. The data-driven investor, however, must resist this allure. Your task is to still seek out the truly wonderful business, the one with enduring competitive advantages and sound financials, even if its price doesn't seem as wonderful as more speculative, short-term alternatives. Therefore, the path forward requires a commitment to continuous learning and unwavering critical evaluation. Apply the data-driven principles we've discussed to your own portfolio with diligence. Remember that navigating the inherent complexities of financial markets demands a keen eye for those hidden risks and an unwavering commitment to informed decision-making. Stay vigilant, stay analytical. Your financial future depends on it.